Hi, everyone, and welcome to our first quarter 2024 investment review. Christian, welcome back. Thank you so much for putting these charts and slides together for us.
Thanks, Darren. Excited to be back.
So why don't we begin? And I think the first thing is a word from our lawyers, where 2 out of 3 dentists agree your mileage may vary and objects are closer than they appear. So that's what they're going to tell us.
Well, following that interesting slide, we'll now get into a review of the first quarter performance year to date for the S&P 500. So U.S. equity markets and broadly global equity markets continued their uptrend this past quarter. The S&P 500 returned 10.6%. Some of those gains have been pared back a little bit to start in April, but nevertheless, it's been up over 47% since the October 2022 lows. One interesting fact this past quarter is we've actually seen a little bit more of a broad-based appreciation in the equity market. So certainly technology and communication services, which have done well, had continued to do well this past quarter, largely on the back of continued earnings growth and margin expansion. But other areas of the market have also started to work. So energy and financials have delivered double-digit returns this past quarter, and industrials also performed quite well. Some sectors are still a bit lagging. That includes the more interest rate sensitive sectors and defensive sectors, such as real estate, consumer staples, and utilities. But nevertheless, we are seeing some of that more broadening that we've spoken about over the last few quarters.
Yeah, and this is something that we'd kind of hoped would happen because, 18 months, 12 months ago, it was very narrow. It was just tech stocks that were moving. And we'd hoped that that would widen out. And we've kind of seen that happen. Some of our long-term favorites like real estate are still struggling along because interest rates moved up so sharply. But it's nice to see, as we talked about, that widening out of support across different sectors. That's actually a good news story.
Yeah, and one area that we've actually touched on a few times now, and we're going to touch on it just briefly again, is valuation. So,
Mm-hmm.
some of the returns over the past quarter have been driven by continued multiple expansion. So that's measured through the price to earnings multiple. Right now, the S&P 500, as of latest quarterly data, was trading at a 21 times multiple, which is about one standard deviation above its historical average of approximately 16.6 times. This is not necessarily a bad thing. As we said, typically it can have a reversion through two means. One is you have a multiple reversion, or two, earnings can eventually catch up to where the multiples are trading at. And as we're in the midst of Q2 earnings right now, we're continuing to be very cognizant of entities that are reporting and making sure that the multiples are being justified through earnings growth.
Yeah, and I think it's important just to take a second to remind everybody when we talk about multiples and that kind of thing, it's when we talk about how stock prices can go up, the first is how the company's making money. So their earnings the company have. So if earnings are going up, stocks should be going up. But then the other thing is what's the price people are willing to pay for those earnings. So when we talk about multiple expansion, it just means that investors are willing to pay more. They're willing to pay a higher price for that dollar of earnings. So that chart that we have been using for years is just to give us a bit of a sense of where are we in terms of are things cheap or are they expensive relative to the earnings of the company, plus what are investors willing to pay. So at the moment, I'd say there's no flashing blue light sale for Kmart shoppers. There's nothing that's really flashing is really, really cheap to buy. So we do need to be mindful that there's a lot of competition out there. A lot of people are bidding things up. But if earnings keep rising, then that can support those valuations.
Yep, exactly. And one area of the market that's certainly remained a bit of contestation is the performance of the Magnificent Seven. And given the performance of some entities year to date, the market has decided to now start coining a new term, such as the Fab Four. So I'll let you think of that as you will. But nevertheless, these seven entities have
So you're
continued.
just hang on. You're going to let it be because that's what you're going to do. You're going to let it be.
I'm going to
Okay.
let it
Sorry,
be.
I couldn't resist the Beatles joke. Okay.
But further to that, really what these seven entities do as a basket have really continued their outperformance year to date. So they've returned an average of 13% versus a market return, excluding those seven entities, of 6%. As we know, in 2023, the outperformance was very sizable. But one thing that we are monitoring, and as Darren just spoke about, is the earnings qualities of these entities and their ability to meet these expectations. So up to this point, we can see on the chart on the top right here, earnings have largely had a large delta towards their competitors in their peer group. Expectations, so forward earning expectations for the coming year, are very extensive. As we can see, they're expecting 37% earnings per share growth versus the remainder of the market, which is negative 3% for this coming quarter. So that is one area that we're watching very closely as earnings seasons continues, is to see if these entities continue to meet these very lofty expectations. Further to that point, though, I just want to make the comment that to the extent these entities have appreciated to date, and some of them may be trading at larger multiples, we certainly don't think these entities are going anywhere anytime soon. These are well capitalized, very large entities with an ease of access to capital. They're generating tremendous free cash flow and profits within their business, which they can reinvest or distribute to shareholders. And many of them are market leaders within each of their respective segments. So it's not to say they're going anywhere. We're just being cognizant of the price people are willing to pay for these entities and if it can be justified.
Yeah, and one of the challenges as investors is people will look to the past and say, well, geez, maybe it'll repeat itself again. That's not often what happens. We look at what's the business doing. It's also interesting that these have been kind of hard to own as investors, because if you look at, the green chart on the left, you had a really good 2021 and then a horrific 2022. We're up 40%, down 40%. And then 2023, if you happen to survive that whipsawing, you had a great year. So, it's risk matters, and what we try to do is get people the return that they require to meet their goals with as little risk and volatility as possible. So we do need some of this stuff in portfolios for sure, but it's really a volatile ride, and there's no reason why they couldn't retrace by 70% the following year and still be great businesses. So we do need to be mindful of the volatility implicit in owning these things. It's not a free lunch.
No, it
But
isn't. And
great example and it's also not 1999 again either. So we don't think these things are going to disappear. We just have to be careful about what price people are willing to pay for them.
yeah, and you can see that in the chart on the bottom right. The dispersion within even the Magnificent Seven has been quite large. In 2023, the worst performing stock was up 48%, better than the market, but the best performing stock was up 239%. And in year to date, we have one entity in the Magnificent Seven that's down 29%, well below market return, and another entity that's up 82%. So even within this basket of very high performing entities, you have to be careful as to which ones you're entering.
Yeah, this is, again, not easy to do. No free lunch.
No. But moving on to a bit of a macro picture, in our fiscal year 24 outlook, one of our high conviction areas was the potential for US inflation to remain a bit stickier than expected, especially what we so coined as the last mile of the inflation battle. So that last portion of inflation to get it down to the 2% target range. So, absent headline changes, some of which can be attributed to a moderate increase in energy prices as of late, the stickiness inflation can be really attributed to a few factors. One of which is the continued fiscal deficit and the accommodative nature of fiscal policy within the US and many governments worldwide. Moreover, we can see that the consumer has remained resilient and strong, and that has in turn supported economic growth, which we'll get to in a slide in just a second. Financial conditions have also eased as of the fourth quarter of last year, and that has in turn allowed additional growth to be fueled through the economy. All this to say, inflation has remained a little bit stickier than many has anticipated, and there is some disinflation in the pipeline through leading sector indicators, as well as through some possible wage disinflation, which we're going to get to in the next slide. But that path to the 2% target we expect will remain quite volatile.
Yeah, and also it's interesting in that chart, you can see the degree to which shelter costs have been really, really difficult to come down. So we were right that we thought inflation will begin to decline. We were a little early on that call, which was good for us. But I also felt it was going to be harder to get much, much lower. So, and I think this is probably where we're going to stay as an inflation rate for a while.
Yeah, and even with some of these refined measures of inflation moving off their lows, such as core and sticky inflation, which help remove some of the volatile components, you have Jerome Powell recently in Washington, D.C., acknowledging the fact that inflation is not moving to the trajectory they had anticipated. This comes in pretty stark contrast to his December FOMC comments, whereby the Fed had essentially declared a victory on the inflation front and were very confident that they were going to be reaching their 2% target in the near term. So that we're just very mindful that of the continued volatility of the inflation battle, and certainly that adds volatility to risk markets. Another area that we're watching, and as I spoke about, is the wage picture. So when we think about wage inflation, and certainly that feeds very extensively into service side inflation, which is a large portion of the CPI basket, we're also quite mindful that the labor picture also gives us a very significant indication into the health of the economy. There are a number of coincident and leading indicators within labor markets, that help to prove this fact. One of this is the job openings, which are still elevated, well above pre-pandemic levels, but as you can see, they've notably come down. Other metrics that we look at in terms of the labor market, in terms of the JOLTS quits rate, as well as new hires, which isn't reflected here, have nevertheless come back down to pre-pandemic levels. So there is some signs of the labor market coming back into balance, especially since very high levels and very elevated levels, which fed into wage growth. And another area that I think is actually quite poignant to talk about is what's been driving recent employment gains in the US. So part-time workers, as we can see on the chart on the far right of this slide, have been driving a significant portion of wage gains in recent months. As we can see, corporations are exuding a lot of flexibility in their hiring practices. Part-time workers are usually quicker to be let go as they're more cost-effective in terms of layoff practices. It's also something to consider that, to the extent that part-time work is taking up more of the labor picture, are these individuals that already have a job and are looking for part-time work? If so, does that mean the consumer is becoming a little bit constrained? That's something we're going to talk about in just a little bit.
Right.
The other part of the labor picture we're also monitoring is labor supply. So over the last year, some of the moderation in wage growth was driven by immigration and an increase in wage and labor supply. So we're just going to continue to be very mindful as to the sustainability of that trend and look out for a lot of these leading indicators to see if it gives us a picture into the health of the consumer and real income.
Okay, good. So in the next slide.
Yeah, and speaking about the health,
because this is one of the key supports, by the way, of
Yeah.
how the consumer is doing his jobs. We're going to look at a couple more now.
Yeah, and speaking about the health of the consumer and real income, we can see that consumption in the US has remained quite strong. Consumption really provides a very deep insight into the health of the overall economy. We can see that consumer spending and GDP growth have been very tightly correlated over a long period of time. And to that extent, this allows us to see, okay, if the consumer is doing well, then our expectations for the economy to do well can continue. To date, there's been no significant signs of consumer weakness, but there are some signs on the horizon that can give us some pause. The first of which is the US personal savings rate. So, as we can see, it is extraordinarily low, well below levels that we've seen in recent years, and certainly now at levels seen not just before the great financial crisis. So, when we consider the personal savings rate being at extraordinarily low levels, we have to think, why is that the case? And is there a possibility it were to increase? If the saving rate were to increase, that means consumers became more cautious, or they ran out of excess savings, which is something Darren and I have spoken to in the past as fueling consumption. Then to that extent, they're no longer able to consume to the propensity that they would otherwise be able to. And that could feed into negative GDP growth. To the topic of pandemic era savings, which was built up through a lot of the fiscal stimulus, which we've touched on in the past,
and the lack of being able to buy anything except toilet paper for a couple of years.
Exactly. There are a lot of metrics now that are showing those pandemic era savings as being depleted or near depleted. So that's one source of consumption that we think will actually be quite mitigating. And when we just spoke about the labor picture, if there's a possibility of wage growth moderation, and so that feeds into real income, if consumers no longer have the same extent of excess savings and they're not earning the same level of incomes they have in the past, then they may need to look towards another avenue to support spending. And that avenue is credit.
Borrowing. So this is the thing. So this is just to sum it up so far. So the jobs picture is cloudy, lots of part-time growth, but not much else. People have spent the money that they saved during COVID. We looked at that. And one of the things we also looked at back then was because people had saved so much money and there wasn't much to buy, the banks had a bit of a hole in their balance sheet because people weren't borrowing. So the amount of credit lending was remarkably down, which is what's hurt the bank stocks to some extent. But that picture's changed dramatically, hasn't it?
Exactly. So that third picture of the consumption index, when we look at the consumer, credit and lending, and I realize this is a bit of a busy chart, but hopefully I can simplify it into just a couple key points here. One, credit card balances have increased at very significant levels. Households are holding much more credit on a personal level than they have in the past when we look at credit card balances. And the cost of that credit is exceedingly high. So the interest rates charged on US credit cards is the highest it's been in almost ever. And other sources of personal credit and personal loans are also at very high levels. So the cost of credit is very high. Credit card levels and personal loans are also very high. So that will add stress to the consumer. It's just not a sustainable trend. The other thing we're looking at is, okay, if this is not sustainable, is there evidence of unsustainability? And that's beginning to feed through delinquencies. So on the
Right.
far right of this chart, we see the transition into the delinquency by US consumer loan type. We see a very sharp rise in credit card delinquencies, auto loan delinquencies, and those are usually the first type of delinquencies to increase prior to mortgages and home equity loans. So those are increasing. And even on the corporate side, when we look at Chapter 11 bankruptcies, those too are beginning to see a tick up. So corporations are beginning to feel some stress of higher interest rates and lending environment. Eventually, this is a reinforcing loop because banks, if they see increasing delinquencies, will become more reluctant to loan because they do not want to incur loan losses. And so, slower loan growth means consumers cannot obtain the same level of credit they had in the past. And so, when we bring this all back together, we see okay, credit has a possibility of slowing. And certainly, there's a lot of leading indicators to delinquencies and levels of credit that show it may not be as easy to obtain going forward. Excess savings have certainly seemed to be run down or in the process of being run down, and wage growth has the possibility to moderate in the coming quarters. So the US consumer and the US economy remains in a very good place, but there are a few flags that give us a little bit of caution and that we're going to continue to monitor to ensure that the health of the US economy continues to stay afloat.
And by the way, all of this is by design. I mean, that's the entire reason why they started raising interest rates, because that's really the primary tool that they have to slow economies down. Is they were thinking it was too hot, there was too much money sitting on the sidelines, the pandemic. So now that the US economy is done very, very well, they raised interest rates dramatically quickly. So that's got the effect of hitting the brakes. And we're seeing that across the board. So the key measures with jobs, savings, and lending, they're all doing what they're supposed to do when people were hitting the brakes. And the trick is going to be, does the US tip over into recession because they hit the brakes too hard? A lot of people think that that's coming. I would argue that economists have predicted 13 of the last 3 recessions. So they usually see this more than it does happen. But that also moves into what interest rates might do, meaning that's the blunt instrument that they have to control this stuff. How good are they at doing it? So I think that's your next slide, right? Is the what interest rates are doing.
Yeah,
Did I
well,
get,
before
did I
we get
get it
into
right?
interest rates, and we do have a slide coming on interest rates, we're just going to bring the picture back to the domestic market because there is a pretty stark contrast between Canada and the US. So, in the US, we talked about a stickier inflation picture, and I did mention some signs of disinflation, but
Right.
there are other parts of the US CPI basket that have begun to increase. And as we mentioned, the US growth picture has been quite exceptional to date. But in Canada, we can see that most measures of inflation is certainly trimmed and median inflation, which is what the central bank will look at. And that removes very large extreme outcomes of the inflation basket, so tail outcomes. Those have all come down, and we can see a very noticeable trend of it looking to return to its 2% target or 2% range. There's actually a real possibility in Canada that inflation does return to a 2% range by end of the year. The decomposition of the inflation basket within Canada also shows a lot of moderation. So, most measures of inflation in Canada have come down, both goods and services. Shelter, of course, has remained quite elevated, and we've spoken about the tightness of the Canadian housing market. Shelter costs, as of the latest print, which occurred in the middle of April, increased about 6.5% year over year, and mortgage costs on an absolute basis increased 25% year over year. So shelter continues to be a driver of inflation, and there's no signs of that letting up anytime soon, with vacancies on new rentals being at absolute low levels. But the remainder of the inflation picture is coming into balance, which should give the central bank in Canada some clarity with respect to the possibility of rate cuts into the summer months.
Okay, so now that inflation is moderating a bit, which is good. Yeah, let's look at Canada and what our situation looks like.
Yeah, and so when we look at the employment picture now in Canada, there's a couple key things we want to touch on. The first of which is the composition of Canadian employment. So Canada's had some wage employment gains in recent months, but if we look to the chart to the right here, that's been driven predominantly by public sector employment. Private sector and self-employed individuals have really stalled out in terms of employment gains in recent months. And Canada now has the second largest share of public sector employment behind France. So this is a trend that's been continuing quite extensively over the last decade. And it's one that we question the sustainability of, given the cost of public sector employment and just the extensive flatlining of public sector and self employed individuals, which are typically large drivers of economic growth.
Yeah, and this is something we're going to talk about in a minute when we get to some of the budget changes. And this is definitely a problem because public sector employees are expensive, right? They're expensive for the taxpayer because they have generally good wages and also very, very rich benefits between, their employment benefits, health benefits, and also most of them have pensions. So very expensive. And the growth of that since the pandemic has been astonishing. The public sector's recovered nicely. Look at the decline in the pandemic to the public sector, right? So it's good to see that recovering. The number that, or the chart that really concerns me is what we've done to our entrepreneur class. We just don't see any growth of people wanting to be self-employed. And that's really not good because small business tends to drive the long-term growth of the economy. So I know we're going to have a chart on productivity in a minute, but this is not a good signal in my view.
Yeah, and one thing that's been quite topical in Canada has been the release of their fiscal year 24 budget. And in this instance, and these are charts obtained through the federal government's projections, so we should preface this by saying these should be more optimistic than your normal charts. We
Yeah,
can
this
see
is this is the best that they can figure out that it's going to be. So it's highly optimistic.
exactly, and we can see that there's really no projection that sees the budget coming into balance. And there's an expectation for Canada to really still have a very elevated debt to GDP ratio, at least what we were operating to pre-pandemic. So when it comes to the budget, certainly there's been a lot of discussion around if it had addressed the concerns of the Canadian economy properly, and portion of that falls on the productivity declines within Canada. And that's something Darren and I spoke to extensively in our fiscal year 24 outlook just a few months ago. So I would urge you to go check that out. It's toward the latter end of that video, but it's quite a stark contrast, both not only to the US, but also our other developed market peers. Canada's been in an extensive productivity decline, and certainly a lot
Yeah.
of the new measures as part of this budget don't seem to be addressing one of the key issues of the Canadian economy.
No, I'd argue it makes it even harder to cover that gap. And that means long term, we have falling living standards in Canada relative to our American cousins, for example. What's also interesting to me about that chart on the left about the federal budget is, first of all, there's no path back to paying our bills. There's no path back to being a break even balanced budget, which I know our prime minister believes that the budget will balance itself, but not according to their own most optimistic assumptions. Now, some people will argue, politicians primarily, that if you look at the amount that they spent in 2020 to 2021, and you can go back and watch our videos on these, the argument was, well, we need to spend that much money to fight COVID. Well, that's not actually true because only about maybe half of that had to do with COVID related measures. The other half were other pet projects that the government decided to spend on, part of which was dramatically increasing by 40% the size of the civil service. So that huge amount of money that they spent, which per capita was more than any other economy in the world, was egregious, and it doubled the size of the national debt. So it's a little concerning to see that amount of money spent and no path back to paying the bills properly. Now, if the government of Canada was my client, we'd be having a really aggressive and harsh conversation. But I don't get to do that with the finance minister. She doesn't call me for any advice. What's also interesting is they keep measuring things on the federal debt to GDP ratio. That's fine. That's one interesting measure. It's the one they like to pick because it's the best of the bunch. If we look at things like total debt relative to the size of our economy, it's not very good. It's because when you start adding, the provinces and the municipalities and individuals, our debt ratio is horribly bad. But let's move on. Nobody really wants to hear that story.
Well, you don't need to listen to just Darren and I when we speak about the prospects of Canada, because confidence in Canada globally has been declining quite extensively. And Darren, I think you could speak to this quite well.
Yeah. So the first thing is businesses aren't investing at the rate that they used to, and you just need to look at just how far that's fallen. So business investment is declining. Again, that hurts our long-term productivity and our long-term wealth as a country, as a nation. And then you look at what global investors are doing, then they vote with their wallets, and look at the negative amount that we've seen just in the last year and a half. The record amount, like we saw a huge amount of selling back in 2007 for a bunch of reasons, and look at what's happened since. So this is not good. Canadian business owners are not reinvesting, and I think it's arguably harder to get them to reinvest given the capital gains changes we're going to talk about. But again, foreigners are selling our stocks at record levels. So none of this is a good report card. So again, you can vote for whomever you want. I just look at the numbers as Christian does, and the track record is poor. And this bodes poorly for Canada unless some kind of change happens. And it's going to be harder to change. It's harder to right this ship later for sure. And so I think in the next chart's also quite interesting.
Yeah, well, the next chart brings us away from Canada for just a second, and it speaks to interest rate volatility. So, at our year-round outlook, another area that we had very high conviction on is that the mispricing in the bond markets was quite extensive. We felt that the fixed income markets were overly optimistic at the time. They were pricing in 6 to 7 cuts at the end of last year. We can see that those expectations have been materially revised 4 months into the year. Now the market is pricing in about 2 to 3 cuts, which is pretty consistent with Fed expectations entering the year. There is also a greater probability through options implied pricing that there are 0 cuts this year than there being 3+ cuts. So that just goes to show you that the market at the time is not always correct. We felt quite strongly that the economic growth that was present within the U.S. was certainly not consistent with the velocity and pace of rate cuts that were to be expected. Now the market has pushed out rate cut expectations to September as the first rate cut, with a subsequent cut occurring in December. So interest rate volatility has been quite extensive, as we can see on the chart to the far right here. And that's added a lot of volatility, not only to the fixed income markets, but also to the equity markets.
Yeah, and you're right. We caught this one right. The view on the street seemed to be rates would drop dramatically. We attended a number of presentations, Christian, with fixed income managers who felt that way. I said, no, I don't think so. I think these numbers are going to be the inflation numbers, and these would be more persistent. So I felt like we'd be in a higher for longer interest rate environment, and we positioned ourselves accordingly. So far, we've been right about that. There is room for them to lower rates, but that's going to lead to another problem in terms of what Canada may do versus what the United States may do. I know we're going to come up to that in a minute.
Well, exactly. There are Canadian dollar implications as towards what the central bank of Canada does. As we spoke about on the inflation picture in Canada, it does seem to be moderating at a quicker pace than the U.S. So certainly, Canada may be in a position to cut rates earlier and to a greater extent than what the U.S. may do. But the U.S. dollar may in turn appreciate through interest rate differentials relative to the Canadian dollar. So that in itself has implications. And then when we bring it back towards the U.S. fixed income markets, there continues to be volatility driven by things such as a re-rating of possible term premium. In the U.S., we've seen financial markets now being increasingly concerned with refinancing announcements. So as we know, the U.S. continues to issue a lot of debt to help fund their ongoing fiscal programs. And so that's been an area of key concern for a lot of market participants, is the rate and demand for the debt that's being issued by the U.S. government. So there are a lot of factors, absent inflation, but also supply side dynamics within the U.S. fixed income market that we think will continue to drive volatility both on the short and long end of the curve. And the last
Okay.
area we wanted to touch on here, and it's something we've touched on in our last presentation, but certainly it's remained a key headline risk for financial markets and globally throughout the first quarter, is geopolitics. So when we spoke about this at year end, we indicated that geopolitical risk and economic uncertainty was at its highest level since 2001. And there's been nothing throughout the first quarter of this year that's let that abate whatsoever. We've continued to see escalating tensions in the Middle East, especially between Israel and Iran now. Ukrainian and Russian conflict continues to occur. The U.S. just announced a massive package for Ukraine and Israel to help support those ongoing causes. We also have the Houthi rebels, which is the bottom graphic on this chart here, continuing to cause disruptions in the Red Sea. We have a U.S. election that we're continuing to worry about later in the year. And we have that ongoing possibility of an escalation of conflict between China and Taiwan.
And this is just the top 4 things we're worried about. There's a
exactly.
bunch more.
We actually have the most active conflicts right now globally since World War II. So there is a lot of geopolitical tension globally, and this has caused disruptions in markets. We're starting to see that now through the performance of sectors such as energy and defensive and aerospace entities. So if we look at the chart to the right here, energy sectors have begun to tick up in terms of relative performance. This has been supported, of course, through increasing oil prices as market participants become more concerned about an escalation of tension in the Middle East and what that could impact in terms of oil supply. We're also seeing aerospace and defense entities tick up in terms of relative performance. So the market is now becoming more cognizant of geopolitical risk, and that's being reflected through the areas and inflows of the market through these key sectors.
Yeah, it's interesting. Just today, I had, as you know, one of the senior leaders of one of the top pension fund managers came to visit me today. We talked about some of these issues and how she said she's generally bullish for a lot of the reasons that we are, but there's this big caveat that any of these things could just set things off in a whole other direction. So, I think the trick for us is to stay to our discipline, to stay with quality, stay diversified, try to get the thing mostly right, but also be able to move quickly if we need to, because any one of those things plus a whole bunch more have the potential to just send things very quickly into the ditch. Whether it's the political situation in the United States as that heats up as we go into the year, although I'm shocked that those are the candidates, but it is what it is. And certainly all the people need to do is turn on their news every night or every day and go, there's a lot of crazy stuff going on. And so far it's been muted. It hasn't created a cascade effect, but any one of these things certainly could. So we're going to stay vigilant. Christian, I'm really glad we have you to help us stay on top of the data and the charts and the graphs and be able to pull it all together. So thank you for doing that. We'll keep on top of this stuff for you at home. Any questions, please send us a note, an email. So with that, Christian, any final thoughts before we sign off for today?
Nope, just want to say thanks, everyone. And of course, we are continuing to monitor all these factors that we indicated. So we're on top of it. And thank you for your trust.
Brilliant. Okay. Thank you for everyone for watching and sticking with us so far. And we'll be back to talk to you on the next one. Thank you for your time.